because sticking to your investment strategy is more important than what you're invested in my opinion. And kind of use another example is I don't care what diet you follow. If you follow it over time, you're going to achieve your results or achieve some results that are better than what you're currently doing.
Your relationship with money matters. I'm Michelle Perkins, and this is the Money and You podcast, where I will be breaking down your relationship with money, offering tough love money tips, and a money dating plan that will focus on lifting the barriers to success to help pave the way for better money practices and increased wealth. It's time to take control to live a limit-free life. It starts today. Hello. I'm Michelle Perkins, a host of the Money and You show. Welcome. We're so happy that you are here listening to the show today. I have a great guest. We're going to get into some investment talk here with a terrific guest who's going to help with some things that you maybe have not heard before. I was really interested when we spoke, and he's got some great ideas that I think were pretty fresh. So let me introduce him a bit. After a decade working in the wealth management industry, in the midst of the global pandemic, Kurt Altrichter decided to resign from his wealth management firm to start Ivory Hill with no solicitation, no clients, and no assets under management. In less than 14 months, Ivory Hill has grown to almost $50 million in AUM. I'm going to let Kurt tell us what that is. Kurt credits Ivory Hill's success to his investment strategy that is hyper-focused on winning by not losing as much. Kurt grew sick of the bear market advisor rhetoric, such as this is a long-term investment approach, and the market will come back eventually, so that we just need to stay the course. He got sick of the industry's investment strategy after seeing clients suffer losses in 2011, 2018, and 2020. In an effort to help investors monitor the changing market conditions, he developed the risk signal, a proprietary math-based and quantitative-based indicator with the goal of lessening the impacts of emotional investment decisions. Kurt started Ivory Hill, a fee-only fiduciary financial advisor firm specializing in holistic retirement plans and private wealth management for forward-thinking organizations and individuals. Ivory Hill is dedicated to creating opportunities for clients to leave their own legacy through customized financial planning, and Kurt specializes in overseeing the finances for closely held businesses, entrepreneurs, and social media entrepreneurs. Kind of love that. Welcome, Kurt.
Hey, thanks for having me, Michelle.
I'm so happy you're here. Two things. One, did I pronounce your name right?
Yeah, Altrichter is.
Altrichter.
I think you were pretty close.
Okay. Yeah, I don't like to be close. I usually ask ahead of time.
There's like a long pause or something like that. So I think you did pretty well.
Thank you. And what about AUM? I stumbled over that one.
Assets under management.
Thank you. Okay.
Yeah. So that's kind of that's an insider term, and basically the only thing that matters to banks and financial institutions, kind of as ego measuring stick.
So that's how you judge, or the financial professionals kind of look at your business. And
more is always better, and yeah.
Okay. Well, thank you. So glad you're here. We had a super interesting conversation, and I know I've heard from listeners that they really want to, learn from this show. They really want to get into a lot of different areas, and the mission of the show really is to educate, to inspire, and to help people kind of feel like they have more control over money and financial matters. So. I love anybody who kind of is an insider in the financial industry and has seen both the kind of the good and the bad. And, and you're one who started your own firm because you saw some things that you didn't really align with. So you want to speak to that a little bit? I always think that's super interesting.
Yeah, I got a pretty big opinion on this that I think that most people probably agree with, but a lot of people might get offended by on this. But I kind of, to give you the genesis, I started out at a big wirehouse, which, to kind of expand on what that means, that's kind of like a big bank, like a JP Morgan, UBS, Merrill Lynch, that type of stuff. And I remember being in the I kind of started as an intern slash trainee, and they had me in a training class with other advisors, and they were a lot older than me, as you can imagine. I remember the guy on my right and the guy on my left were both unemployed for about a year and a half, which is nothing to them. But they found the job description based on like monster.com or something like that. And, you kind of go through your little training. You get some really old school sales tactics, literally the broil system, the broiler room, if you've ever seen that movie, on how to actually sell. And within about 2 weeks after passing your tests, you're out there managing people's entire life savings with absolutely zero capital markets training whatsoever.
Wow.
And, everyone's kind of got to start out somewhere. The industry's never really made a lot of sense to me when you're, 22 years old. And another thing that they kind of put you in at these big firms is you have to bring in, at least $1 million a month or $12 million a year, or else you essentially don't get paid or you get fired.
Wow.
And so it can be kind of cutthroat. So you kind of got to hit the ground running right away and start kind of gobbling up those assets so you can pay the rent. Well, through that, so the advisor's really sending it is to sell, which so the firm gets paid more, get more assets under management, more AUM and whatnot. And so what we used to do at UBS, I was kind of working under another advisory team. You kind of bring in, Michelle, you're a moderate growth investor. We're going to throw you in our firm's moderate growth portfolio. And there's 5 model portfolios, conservative all the way up to aggressive. And then we kind of stick you in that and we never look at it again because it was managed by like the firm CIO and we never made changes to it. When the market was down, we told you that this is long-term money and the market's going to come back eventually because it always does. And I struggled with having those conversations with clients. Well, at the time was really kind of assisting with that through the years. And then it wasn't until I really started building my own business and I had people, that I remember I was managing money from some of my childhood's best friend's parents across the street, and he was down, 18, 20% and just retired like 2 weeks before that. And I started I didn't like not having that confidence in what was going on into that, because this kind of buy and hold nature is, in theory makes sense. And if you look at the chart, you'll see, it goes straight and up and to the right every time, and that's always good. But kind of, one thing that I do not agree with is what the chart, the kind of the sales chart that we show you, which I'm sure you've seen, is on, hey, on a 20-year rolling return, you're always going to make money no matter what. And that is, and the reason why it's 20 years is because anything less than that wouldn't be positive for the firm. And so the firm needs you at these big Wall Street banks. They need you to stay invested so then they can get paid more. They won't sell the cash because they can't get paid on cash. At least that's how it was when I was there. And so they need to keep you into it. And they say, if you pull your money out, you're going to lose, the biggest up days and the biggest down days. Well, what they don't tell you is that the biggest down days usually are followed by the biggest up days in the market and whatnot. And so I kind of just grew kind of sick of this kind of boilerplate cookie cutter type world of investing that we've kind of designed a narrative around, and really look to something a little bit better that people can understand. And but it does take a little bit of a unique client to really do understand that. I kind of talked in circles there a little bit. I'm hoping you had some clarification questions.
You did not, actually, and I think that's fascinating. I was, I realized how much I didn't realize that, because I thought somebody was, in fact, looking at my assets and evaluating them on a rather regular basis. And the way you explained it was pretty eye-opening. So,
yeah, I mean, to give you an example, I mean, when I was an intern at I won't name the firm, when I was an intern, my job, so we had our 5 models. Like I said, you had the cookie cutter, this is how much in stocks, this is how much in bonds, this is how much in emerging markets, this is how much in international. We kind of had our own models built out. And then my job on a quarterly basis was go grab JP Morgan's, go grab Goldman's, go grab, so whatever it was and look at their models, and they're damn near exactly the same. But if they made a shift, and if we had 2 out of 3 shift to a different asset class, then we made a change, which is not a bad way to invest, a copycat, just for anybody who's currently doing that. It's not a bad way, but it just didn't really. I didn't like. What's the narrative behind it? Why are we doing these certain things? Is what I didn't understand. And when I later realized that, and you're seeing it now with earnings, everybody at the beginning of 2023 said recession's coming, it's imminent, it's guaranteed, and then the market goes up a little bit because of this AI mania, type stuff. And by the way, whoever says AI in the earnings calls the most, their stock goes up the most. So I don't really have an analysis on that for you, but when they're kind of all sheep that, and then now you're seeing almost every single Wall Street bank has changed their outlook on the U.S. economy and saying no recession, and they all just kind of dominoes in a row have changed their viewpoint on that. And so the second I stopped using Wall Street research is the second I started actually making I would consider good money in the market, because there are a bunch of things behind the curtain that you don't really know. And can't remember which bank it was. They had a sell signal on I remember a foreign stock, like an ADR, American Depository Receipt, that you can buy, in your Schwab account if you wanted to. And they flipped to buy kind of randomly. And I just remember that caught my eyes, and going back and looking into it. Well, it's because, and I'm pretty sure the bank was JP Morgan. If you know any JP Morgan advisors, they had nothing to do with this, just per se. This is more of their analysts. And they flipped it to buy, and I later found out that they flipped it to buy because they helped that company IPO, and they needed that stock price to rise in order for them to make money.
Whoa.
And so there's a lot of misleading information that comes out of Wall Street banks. That being said, I still like the follow because I want to know where the sheep are running to and which slaughterhouse they're going to, for lack of a better term.
Wow. Okay. Very interesting. So when you started your firm, what was your goal? How are you going to change this for people?
So my goal was, and the firm that I previously was at, it's more of like a kind of a group think mentality. And it is at a lot of other firms where you don't really, if I want to go buy something in a client portfolio, I have to pass it up compliance, then it's got to meet our investment policy statement. Then we got to do this. And by the time anything comes back and approves, we missed the investment opportunity altogether. And so what I want to do is bring something a little bit more unique to the marketplace, for your everyday, millionaire next door, to actually kind of implement. Because I kind of got my buddies in the industry call me a little bit of a cowboy, where if I'll try to find a solution basically no matter what, in order to make that client happy or to make a situation work. So what I wanted to do was manage money the way that I manage money myself. And that is hyper focused on downside risk. And so my indicators kind of follow, I got 3 different indicators. There's a short term, an intermediate term, and a long-term indicator. And the first 2, the short and the medium terms, are early predictors of volatility. And the reason why I care about volatility is because volatility is mostly associated with down markets. And so when those indicators flip red, as I say, or flip, risk off, what we want to do is look at repositioning that portfolio from, maybe aggressive equities like tech would be a good one, or oil or anything like that. Well, oil is more of a commodity, but maybe those kind of high-flying tech stocks, and then maybe into something that's a little bit more boring, like utilities. So we're not like selling cash necessarily right away, but we're just moving into something that's a little bit less risky, and that hopefully we can either make money on it, and by doing that over and over and having that kind of beta rotation in your portfolio, has proven through back testing and in real life that it can provide outperformance by not losing as much.
Wow, that is super interesting. So I want to dig in a little more into this kind of, avoiding downside risk, because I found that to be also really interesting when we talked. It's not something that I've thought about that much, but the way you explained it was so perfect. If we can minimize that, then, because, I'm thinking, okay, things go up and down, and like you say, ultimately you're up here somewhere. But by avoiding some of those downs, you're saying that you can actually, you can help people just earn more by that little shift.
Yeah. So if your portfolio is going to draws back or goes down, or the account balance is down 40% during a market sell-off, you need in order to break even, you don't need the market to go up 40%. You need it to actually go up 67%, just to break even. And that can take, over the course, that's not you. 2020 was kind of the exception to the rule, and the Fed panic prints, $6 trillion into capital markets. The market goes straight up. But talk to people who were in 2000, 2008, that took them, 3, 4, 5 years just to break even, depending on what you're invested in. Especially stocks, and kind of goes back to my kind of earlier point on that 20-year rolling return. And if anything less than that 20 years wouldn't work, because there's periods in time in market history where the market just went sideways for 18 years, or 16 years or 15 years. So you're not going to make that kind of 12% that they say you're going to get in the S&P 500. That is the average annual return that you're going to get. But I've never seen a market that is always average or normal. There's no normal periods in the stock market. There's periods of heightened volatility, low volatility. I'm a big fan of boring markets. I want, sideways markets, slowly moving upwards. That's always good to invest in. But one of the reasons why, volatility is becoming more and more increasing is, I know that a stat a few years ago published by the Wall Street Journal was that roughly 85% of all trades entered in on a daily basis, so every day, so today, are through automated trading strategies and quantitative, kind of quant-based strategies that are buying and selling every 2 seconds throughout the day. That's a lot, and they kind of all move in sequence with each other. They're called volatility control managers, and so as volatility, declines, they're buying, and when it's increasing, they're selling. And now, what I think is even more scary about that is the introduction of AI. Yeah. And so now you're going to think, and this is maybe me with a tinfoil hat on my head, and I've watched maybe Silicon Valley too much. But it's going to be AI against AI, and you're going to have the human to arbitrage the situation and come up with counter strategy. So buy and hold investing is great in theory, and passive investing is always good. But I think as the market dynamics continue to change and technology advances, you're just going to have to be okay with your account getting ripped in half every year to 2 years down the road. So having an active portfolio management strategy, obviously I'm biased because that's what I do. But going forward, I think it's going to be necessary in order to protect your capital.
Wow, that's super interesting. I was going to ask about how just, all the automation in the financial industry has kind of interfered with that old paradigm too of just buy and hold. But you just answered some of that. Are there any other things people need to know about that aspect of it?
Know how the strategy works if you're going to be doing automated. I'm a fan of rules-based strategy, and my entire investment process is rules-based and can be automated. But just so you know, I was kind of testing it out on a personal account of mine actually a few months ago. And I thought of everything. And this was one that was monitoring, a list of, 1,000 stocks, and it would buy and sell based on that. So it was a little bit intricate, a little bit more advanced than what I'm currently doing. But what I didn't factor in is the power going out. So the power went out and the trade stopped going through. Wow. And granted, it wasn't like a huge market day, so it didn't actually cost me any money. I actually probably made a little bit more that day. But you got to know exactly how those systems work if you're going to, especially if you're going to give somebody else your money. I don't think you need to know. They probably won't even give it to you because quants are very protective of their strategy, because usually it's a pretty standard strategy that they tweak just a little bit to give them some edge. But it's going to get crazy. There are, I'm a part of the ETF think tank as well, and I know there's a few ETFs out there that are 100% managed through AI that were doing really, really well actually the last year or so, kind of until this AI mania happened. and whatnot, but you got to know exactly how those work. And so your expectations, because expectations in investing is everything. When it comes to kind of your active management and what manager you're using, I think it makes sense to diversify amongst investment strategies as well as asset location and asset allocation.
That's an interesting one. Yeah. Okay. That's something you don't typically hear. You typically, I think people operate with a strategy, not multiple strategies to kind of balance things out. But that's a really good suggestion. And most of us would not know how to do that. So that's another reason why you need somebody with a little more expertise for that one.
Yeah, you don't necessarily need, like, I'm a little bit unique. I'm the guy who's actually pulling the triggers. There's a number of resources out there for financial advisors, like especially with the CFP type advisor who's financial planning only, basically. And if he's managing money, I don't want to throw a stat out there, but I would say most of them are putting you in a buy and hold index portfolio that is maybe rebalanced a couple times a year, but they're not really going to be that strategic with it. But there are, a lot of good resources where advisors can use outside money managers. And instead of just putting them in a buy and hold index strategy, kind of put them into something that has a little bit more active management, that's going to look at beta, that's going to run away from the market as opposed to running into the market, kind of depending on what it is. So those resources are out there for advisors. So if someone is, maybe listening to this and they're not happy, you don't need to, you can kind of guide your advisor into the right direction as well. And I spend my day talking to advisors too. So happy to speak with anyone who's looking to for a template on maybe a different way on how to invest client money.
Yeah, this is really interesting. And what I can hear, in this conversation is your interest and kind of passion around this. And, if people are managing your money who, really aren't managing it, they're just popping it into a system, there's a big benefit to what you're doing for people because you can kind of nerd out on this and get into it and find better ways. And so it's kind of a big deal to know that some people are getting minimal training and just kind of, going through whatever process it is that they're told to go through versus somebody who's actually thinks this stuff is cool and is really trying their best to understand it and go some different ways with it. So, I think this is, have you found it? It's also more stressful, I would imagine, because you are more involved. So there's a little more on you for your clients. How does that feel?
So, yeah, to say that, absolutely, I'm looking at the market, definitely a little bit more than I was in my first, infancy years in the business. But again, I guess kind of the advantage that I did have is I was running it on my own money for a few years before I actually started implementing it into clients. So I had expectations set for myself and rules around where it is. But the entire reason why I developed these signals and everything was to really take that emotional piece out of the investing equation, because that's usually where you're running into problems. You can see right behind me, I have what I call the financial pornography news network. And you're sitting there listening to them, and it's drawing you in. You're getting sucked in. Oh, I don't own gold today. I don't own silver. Oh, Nvidia stock's up. Why don't I own that? I'm going to miss out on that. And you're making investment decisions based on that. Then, that's where things happen. I can tell you that the whole reason why I kind of came up with that is because I made all those mistakes. Before I have bought high, I chased stocks, I have waited in cash too long. And so the signal, it's rules based. And for lack of a better term, we blindly follow those rules. So, if higher volatility is likely, we're going to position defensively, even if the macro environment or everything else says that it's not going to happen. We're still going to follow those rules, because sticking to your investment strategy is more important than what you're invested in my opinion. And kind of use another example is, I don't care what diet you follow, if you follow it over time, you're going to achieve your results or achieve some results that are better than what you're currently doing.
Yeah. So you explained something to me when we spoke before that I thought it really clarified it for me, that, there's certain industries that you might be observing to see, if they are going up or down, then that's kind of your little indicator that you need to do certain things. You want to explain that?
Yeah, so kind of one of the kind of core components, it's not our entire signaling process, but one of the areas that I think everybody should follow is the utility sector. And so the reason why I think the utility sector is important to follow is it's kind of like the most bond-like sector of the equity markets. Why is it like that? Well, there's a bunch of regulation around utilities, and most people are going to continue to pay their utility bills, to keep their utilities operating and where they're living and whatnot. But they're kind of a little boring, unsexy piece of the market that not a lot of people, I don't think, really focus on. But when you see utilities outperforming the overall market, and I kind of monitor it on a monthly basis or about 4 weeks or so. And so on a 4-week moving average or rate of change, if the utility sector is outperforming the S&P 500 on a 4-week rate of change, that shows that inside the market, again, I don't care about capital markets assumptions or whatever JP Morgan's publishing, because they're basically worthless now with the introduction of automated trading. But when utilities outperforming the S&P 500, that's showing that inside the market, traders, big institutions that are churning billions of dollars of capital on a daily basis are getting more defensive, and they're getting a little bit more cautious. And so I use that as kind of a guideline of, maybe that's a signal that higher volatility is going to happen. And so we position for that in advance. And another signal that I kind of came up, it's actually the founder of it was actually Michael Gayad. He created what's called the lumber to gold ratio. And so the way that works is, first of all, lumber, when the price of lumber is going up, that shows that we're building houses, and that's important because that shows we have a red hot housing market. Most people's, entire wealth are in their homes. And there's also a kind of a credit component to that because a lot of people have mortgages on that as well. So that's why that matters. Another reason why I follow lumber is that it doesn't really move that much. It's usually going up for long periods of time, and then it starts going down for long periods of time. And when it's going down, that shows that we're not building as many houses, and that shows that our economy is likely to be going down. And so when the price of lumber is declining, that tells me that's also another early indicator of volatility, that housing, because housing always leads the equity markets. And so lumber, it's down quite a bit. It's like 60-70%. I want to say it's still down right now. And so it's taken a while for housing to really start turning over. It's slightly turning right now, but at some point you're going to expect that housing market to start really starting to roll over. Now, when I say that, it doesn't mean it's a 2008 or anything like that. We have enough population and demand to keep, housing, it should correct relatively quickly. But kind of back to the ratio of lumber to gold. And so if you take that on the chart and you take the price of lumber divided by the price of gold, and if you have gold outperforming lumber on a 13-week, rate of change or moving average, that tells you, well, not only is lumber going down, and so our economy, kind of a macro head component, is that, our economy is deteriorating, but then you have investors flocking to gold, which shows that people are getting more defensive and that those big institutions are getting more defensive, and that's also another early indicator of volatility as well. Wow. And so, that signal, unless they create something else to build houses with, I really, that's one of my favorite signals to follow. It doesn't move the market right away. It doesn't mean that the market's going to crash tomorrow, but, you can kind of see the lag time on that is a month or two or so. And by the way, today that signal is green, as well as the utility signal, which means that it is time to take on a little bit more risk right now.
Interesting. Wow. I don't know. I think this is fascinating because it's like getting us, a few steps back from what you're hearing out there and getting an actual understanding. There's just so much So much craziness out there, and people are getting their, financial information from TikTok, and it's just so crazy. So,
don't get me started on that.
Yeah. But I love that. That's a very sophisticated way to look at things. When you say you take that information and then you look at repositioning, can you explain, kind of in a bit more detail about what that means for people who aren't seeing
and
that?
I guess kind of maybe throw into a context for people who are like totally checked out of what I'm saying by now. But, kind of the way I look at the market is kind of like, a meteorologist is going to monitor indicators like air pressure, wind speed, weather front, humidity, that type of stuff. And kind of, I would like to say similarly, we're following things like that, that kind of measure market conditions. And market conditions matter because they go ahead and they dictate probabilities, and then probabilities dictate outcomes. And so to use steal an example on this, if you're, driving down the road in your car, I'm not gonna be able to tell you exactly what mile marker you're going to get in a car crash. But I can tell you that, hey, conditions say that a crash is likely. Maybe it's time to, maybe stop driving over the speed limit, crank that down, maybe get the windshield wipers going, turn down the music, increase your awareness a little bit, because it's likely you're going to get into a crash and you're prepared for if it does. And so by, kind of slowing down and speeding up, yes, you're going to miss out on some returns, but when that big crash does, because our whole investment philosophy is trying to avoid 85% of that market crash. Mm-hmm. So in January of 2022, when our long-term signal, which is different than the two that I kind of briefly discussed, turned red, that is a reactive signal. And so when that turns red, we will raise cash. So we raised client cash up to about 70% of their portfolio. And we sat there until February of 2023. So we missed the entire, about exactly 85% of the sell-off, the 20% sell-off. And then our signal flipped green. We started slowly layering back in.
Wow.
And so, that's, and I had a problem that most advisors were trying to talk clients off the edge. Well, I had the opposite problem during that time, actually. I had clients coming up with, hey, my brother-in-law says this. And whenever a client calls me with, hey, my brother-in-law on Thanksgiving or whatever it is, it's like, oh, whatever, this XYZ penny pink sheet stock that's owned by a PE firm in Canada is supposed to go to the moon, and that type of stuff. So kind of coming up with more alternative investments for the clients that truly makes sense for them, because they're just we were just sitting in T-bills and cash earning 3, 4, 5%. Well, the signal was still red, and it's just an interesting dynamic compared to what I had to use to go to. It's a good thing, but keeping clients engaged with their money, and not making hey, I'm sitting on so much cash right now, we need to do something with it, isn't always the choice.
Yeah. That's so interesting. And I love that. And I love the fact that you were able to, because, the show is a lot about relationship with money. So all these people coming to you have their own, very unique relationships with money. And, what's your philosophy or strategy around helping them to get comfortable with sort of the way that you do things?
So I try to over communicate. So I write a newsletter. And I try to stay on top of it. It usually comes out about once a week on how, and I say right out in there, basically, this is how we're positioned. This is where the signals are at. This is what you can expect in the next week or months, on what's going on in the markets. And not everyone's the same. The 35-year-old with 400,000 saved that wants to grow that into a massive wealth is going to invest a lot different than a retiree. So, with, retirees that are sitting on a fixed income, do we need to outperform the market? That was my primary question. Is it like we're sitting in cash right now, because bonds were down 40%. That's another reason why I don't like passive investing, is because it was pretty obvious as the Fed raises rates, bond prices go down, to do that. And it's like, so let's just buy some CDs and lock you in at 5%. We're guaranteed to get 5%. in the next 12 months. And what are you going to miss out on? You're going to miss out on probably another 6% if the market does well. And we don't need, by the way, in order to meet your financial plan, we needed to hit, 3.5%, every single year. And so that kind of helped us out. It doesn't help us from an inflation standpoint, because I do have an opinion about inflation as well, on how the government has said that inflation's at 2%, every year, when it's not at all. And so like in Minnesota, I know inflation actually on the normal most bought goods and services of your average household is actually hovers around 9% a year.
Whoa. Okay.
And that's another conversation you kind of have to go in with people that are living on a fixed income, because again, the narrative has always been, once you get retired, switch to bonds. You get your 2.5%, 3%, you'll be good. Well, no, you either have to have a bunch of money and live on a lot less than you think you have if you're going to go that way, but I'm sorry, your money's not going to keep up with inflation. And so that is something that I do have an opinion on, because kind of to use a story, and maybe this might be relatable, might not be, but I remember when I was about 12 years old, my grandma used to send me birthday cards. And I remember I got $100 bill, and that was like a lot of money for me back then, right? And every year, I kind of get 100, and then over the years, that 100 went to 50, and that 50 went to 20, and then after a while, I just kept on getting just a card. Well, that's because grandma kept all of her money in CDs every single year, or in treasuries that never kept up with inflation, because inflation is more than 2%. And so that is something that to kind of monitoring, and hey, we need your equity exposure. It's more of like a 50-50, not at a 90-10, where that's where the kind of the industry wants you, or that's what like the target date fund portfolios want you to be in.
Interesting. Yeah, that's a great analogy and story. Well, Kurt, this is super interesting. I mean, I think people, well, I'm going to subscribe to your newsletter, so I hope other people will. And can you tell people how to get in touch with you and get more information?
Yeah, so I'm at, so Twitter is probably my primary social media. It's this Kurt S. Altrichter on Twitter, and then my newsletter is through Substack, or you can find it on my website at ivoryhill.com.
Okay. Yeah, that's great. I really admire your approach. One thing, before we leave, we're sort of out of time, but you had mentioned that you work with social media entrepreneurs, and I would just love to hear a little about how that became one of your market niches.
So I ran into it kind of by accident. I used to work with a lot of professional athletes. And actually, one of those NHL hockey players, actually, girlfriend, built an online business. She's kind of a model, and then also has some affiliate marketing and that type of stuff. And there is talk about a totally different way to not only make money, but I couldn't believe how much she was bringing in. She was kind of my first introduction to this new industry. And I mean, she's pulling in anywhere between $300,000 and $400,000 a month. And at 20 years old, that's a lot of money to do with. And so they're like, hey, we need to think down. We don't know if we want to help you out. And I kind of help my client, not his girlfriend, out, kind of start some businesses and kind of do that. But this is a business that I had absolutely no experience with, or how it even worked. And I could not believe that she was bringing in that much money. Just on, Instagram and TikTok. So I do think that everyone should, I don't believe it's going away. We're seeing now more big companies, like the Apples and the 3Ms and the Home Depots and those type of worlds are actually starting to target marketing on people with large social media followings, because they're going to get more traction there than they are on a Hulu ad or a radio ad or anything like that. So having a big audience and a reach is a massive benefit. And I wish it was something that I would have focused on a little bit more earlier in my career. And I think that it'd be a huge thing for any entrepreneur, is figure out the algorithms on social media, figure out what works, keep it entertaining. And then what I liked about that particular client is she came to me before the money started, before she decided to start monetizing it. And I couldn't believe how, because I think she had like 800,000 followers on Instagram or something like that. And she wasn't making any money on it. This was all just organically built type stuff. And then she started to monetize it. So building that audience and having people that care about what you have to say, I think is a big thing. And I'm here, the finance guy. I don't know. I'm not a great marketing guy or anything like that, but that would be my advice to any young entrepreneurs is figure out social media. It does matter a lot, and you can make a lot of money.
Boy, that's so interesting. And it's great for you as a finance person to be able to have insight into that. And wow, smart for that 20-year-old to be getting a financial advisor to manage that money. So yeah, pretty amazing. So, okay. Well, Kurt, thank you so much for being here. And again, ivoryhill.com. Reach out to Kurt, get his newsletter. And I think... you're a real resource for people in an industry that is fairly static in how they operate, it sounds like. So, and I just think it's really great to be giving it as much thought as you are and trying to find ways that are a little bit smarter than the group think. So, yeah, thank you for sharing with us today. Great conversation.
Thanks for having me on, Michelle. I really appreciate it. Everything that you do.
You are very welcome. Loved it. So, okay. And audience, thank you so much for being here. Love having you watch and listen to the Money and You show that can be found on Roku and the YouTube, Limit Free Life YouTube channel and all the podcast platforms. Please leave us a review, a like, whatever you want. Share it with your friends. We are really trying to bring more very kind of diverse financial information to people so you can get a great financial education and just insights into things so that then you can pick and choose from the wild mass of things out there and develop your own financial plan that makes sense for you and your personality and allow you to have your very own very special relationship with money. And I think that's so important for everybody to be paying attention and be engaged. And there are, as you can see from the show, so many ways to do that. And so, find what works for you and what you'll be interested in paying attention to. So as far as that goes, if you're more interested in learning about your money relationship, I have my upcoming September money dating course where I chaperone you on a series of money dates so you can understand your relationship with money and how it's impacted you in your decision making and improve that where it needs to be improved and learn some foundational basics around finances and get yourself going on that journey. All right. Thank you so much for being here. Thank you, UBN Go, for producing this show, and we'll see you next week.